China's coming back, OPEC continues to produce oil, and the dollar is no longer an overhang on the global markets. You might say things are better than we expected. Coming up here on The Jog. Hi folks, Alex Klingelhoeffer here with Exencial Wealth Advisors. It is 8:51 here in the middle part of the country on Monday. It is December 5th, 2022. Here's your morning jog around the economic headlines of the world. And of course, today is the day that Russian oil can no longer be shipped to EU countries, at least not by boat, right? They can still pipe it over, although Germany has said they're going to take that down by the end of the year. Now, let's talk about China. As the marginal consumer of the black stuff, they are easing their COVID restrictions. We talked about this a little last week. There's some additional information came out over the weekend. Looks like Shanghai is really opening up. No longer have to show a negative test to get on buses, go to parks, etc. So let's spin this a little bit forward. If we get some good news here, we've got about 6 weeks for the Chinese to start consuming, and then they have the Lunar New Year. Right? But I guess that'd be more like 8 or 10 weeks. They'll shut down for about a week and then they'll come back in force in Q1. What does this mean for the global economy? Well, we've got OPEC. They're continuing to push some barrels down the throats of the Chinese, quite frankly, because they're also buying the Russian oil. Indians are buying Russian oil. OPEC wants to get every barrel it can out, but still have the threat of reducing production so that we stay between $70 and $90 a barrel. Russian oil price caps at like 60. Everybody is good. Everybody continues moving the global energy supply. Now, on a investing basis, what does this mean? Well, it does mean we're kind of in a sweet spot for the vast majority of global assets. Energy is not too high that it starts crimping the global economy, and it's not too low that folks start shutting down production. It's right where it needs to be. And that is a good harbinger for 2023 after we had a terrible 2022. Let's be completely clear. 2022, when you combine the stock and bond markets drawdowns, is one of the worst years ever in history, especially for like a 60-40 balanced portfolio. On a go-forward basis, what does this mean? This means when we look at international markets, they're now becoming relatively more attractive than they have been for the rest of the year. We talked about the dollar coming down off the top. Now it's about 7% up for the year. Was about 16% really weighing on international assets. I think we are setting up, if we get some Fed accommodative policy going forward, for a really nice back half of 2023. You have all of these headwinds from inflation that are subsiding. You have all of the geopolitical disconnections that are riling up, but that kind of creates a frontier for some additional gains. Prices have been depressed throughout the entire investment landscape for more than a year. It seems to make sense that we have a nice 2023 ahead of us, given the factors on the ground. If you want some additional info throughout the week, feel free to find me on the internet. I'm out there. Until then, you and your family, hope you have a really good rest of your week. I am out.